The US Treasury bond market is sending a distress signal right now that could trigger the most violent precious metals explosion in modern history. What I'm about to share with you isn't speculation or theory. This is happening in real time, and the implications for your savings, your retirement, and the dollar in your wallet are staggering. Let me walk you through what's unfolding and why a handful of analysts with decades of experience are predicting silver could rocket past $300 per ounce, while gold surges beyond $8,000 within months, not years. Right now, we're witnessing something extraordinary in precious metals. Gold is pushing toward levels that seemed impossible just 12 months ago. Silver recently touched $94. And if you think that sounds high, you need to understand what the technical patterns are actually telling us. This isn't your typical bull market where prices climb steadily and consolidate. What we're seeing is a completely different animal. For over a year, gold and silver have been moving in what I call an exhausting pattern. They surge a few $100s, then go completely sideways for months, boring everyone to tears and convincing people the rally is finished. Then, boom, they explode again. But that pattern is changing. The consolidation phases are shrinking. What used to take 5 months now takes 2 months. What took 2 months now happens in weeks. What happened over weeks is now compressing into days, even hours. When you see acceleration like this, it's telling you something massive is building underneath the surface. Here's what most people miss. Everyone focuses on the price of silver or gold in isolation. But there's a much more powerful indicator that reveals where these metals are actually headed. It's the ratio between them. The spread relationship. How much silver fits into 1 ounce of gold? Right now, silver represents roughly 2% of gold's price, but that's historically suppressed. Back in 2011, when silver last hit $50, it was 3.1% of gold's value. Go back further to 1980, the first time silver reached 50, and it was 6.5%. Why does this matter? Because silver has been systematically undervalued relative to gold for decades. It keeps bumping against a ceiling and falling back. But in November, something critical happened. Silver broke through a multi-year resistance level against gold that had capped it for years. When you study market history, you find precedents for this kind of breakout. Copper did it in 2005. In just a couple of quarters, copper quadrupled without help from any other market. It simply said, "I'm done with this old range," and exploded into a new reality. Lead did the same thing in 2007. These weren't gradual moves, they were violent revaluations. And that's exactly what the technical work is suggesting for silver right now. We're not talking about a move to $100 and calling it a day. The analysis points to a new reality for silver, somewhere between $300 and $500 per ounce, with the bulk of that move happening in just a few quarters. This isn't a bull market. This is a monetary reset in motion. Think that sounds crazy? Let me give you some context. Look at gold's historical bull markets. From 1976 to 1980, gold went up 8 times, 8-fold gain. Then from 2001 to 2011, another 8-fold move. Gold has already proven twice in the last 50 years that it can deliver this kind of performance under far less dramatic conditions than what we're facing today. Our bear market low for gold was $1,150 back in December 2015. An 8-fold gain from there puts us at over $8,000. And we're currently only at about 4 times that bear market low. We're not even halfway through what gold has historically delivered. Now apply that same logic to silver. If gold reaches 8,000 and silver returns to even its 2011 ratio of 3.1%, you're looking at nearly $250 per ounce. If it reverts to the 1980 ratio of 6.5%, you're well into the hundreds. But there's something even bigger happening that's going to accelerate this entire process. And it's terrifying. The United States Treasury bond market is in crisis, not the stock market, not real estate, the bond market. And most people have no idea how serious this is. Treasury bonds crashed hard between 2020 and 2022. Prices collapsed, yields exploded. That low point hit in October 2022 at 117 on the 30-year bond futures. Since then, we've seen 3 separate attempts to rally, 3 attempts to stabilize. All 3 failed. Right now, bonds are trading in the 114s. They even dipped into the 113s recently. The technical analysis shows that the 3-year attempt to form a base is failing. And if bonds drop just another 3 points or so from current levels, we could be looking at an outright panic in the debt market. Let me be clear about what that means. A US Treasury bond panic is a nuclear-level event for the financial system. It dwarfs anything we saw in 2008. The mortgage crisis affected homeowners and banks. A sovereign debt crisis affects the entire foundation of global finance. And it's not just US bonds. Japanese government bonds effectively crashed recently. Yields exploded. UK bonds are deteriorating. Bonds across the Western world are showing severe stress. This is a coordinated unraveling of government debt markets that are exponentially larger than stock markets. The Federal Reserve knows this. That's why in November, the president of the New York Fed announced they would start buying bonds directly. The official excuse was to provide liquidity. But watch what happened after that announcement. Bonds went dead flat for 2 months. Daily ranges compressed to almost nothing. It looked like a coma, not a market. They were buying, but the rallies couldn't gain traction. And now bonds have broken through that recent floor despite Fed intervention. If they've lost control of the bond market, and the evidence suggests they have, the ripple effects will force central banks everywhere into emergency mode. And that's when the printing presses go into overdrive. Here's what people need to understand about money printing. When central banks create currency to bail out collapsing bond markets, they're not solving the problem. They're making it worse. Every dollar they print dilutes the existing money supply. It's pure debasement. Go look at the M2 money supply data from the St. Louis Fed website. Every decade, the money supply increases roughly 80 to 90%. That's why your grandfather built a house for $4,500, your father built one for $45,000, and the median home today costs $450,000. Same house, decaying currency. When the Fed prints to save the bond market, gold goes berserk. Because gold is real money. It can't be inflated, it can't be printed. Half the world already understands this and is shifting to gold. Central banks have been buying record amounts. They see what's coming. The Western world is late to this realization, but when a crisis forces the issue, when people's retirement accounts get hammered and their dollars buy less every single week, emotion enters the picture, and emotion creates panics. Silver has been artificially suppressed for years. When you try to manipulate any market and hold it below its natural level for too long, you're creating compression. It's like holding a spring down. And when that barrier finally breaks, the move on the other side is far more violent than it would have been naturally. All that pent-up energy releases at once. Suppression doesn't eliminate pressure. It multiplies the explosion. That's what we're starting to see in silver specifically, and gold more broadly. The upside panic. Now, I want to talk about timing because this is critical. Looking at historical silver explosions, there's a consistent pattern. From September 2010 to April 2011, silver went up 2.5 times in 7 months. From 1979 to 1980, it went up 5-fold in 5 months. These were vertical moves. But here's the interesting part. In the middle of each explosion, there was a stumble, a sharp correction that shook out weak hands. For example, in January 2011, silver had a monthly reversal. It made a new high but closed down for the month. Technical traders called it a reversal signal and got bearish. The very next month, silver blew the roof off and went even higher than before. It was a midpoint shakeout in a much larger move. If the bond market continues deteriorating for another few days, you could see the Fed panic in a way we haven't witnessed before. That could be the catalyst that sends silver vertical for several days straight. We could see limit-up days on the commodity exchanges, 10% moves in a single session, shorts getting trapped and unable to exit. Silver could spike to $120, $130 before taking a breath. And that breath, that midpoint correction, might coincide with external events. There's speculation that a Supreme Court decision on tariffs could temporarily calm markets if they rule against the current policy. That kind of headline might put a temporary hose on the fire, but it won't stop the underlying trend. The forces at work here are far bigger than any single policy decision. At that point, all the people who've been shorting silver, all the analysts saying it's topped out, all the retail investors who thought they missed the move, suddenly realize they're on the wrong side of history. The panic buying begins, and that's when things get truly wild. Within the next 6 months, possibly sooner, don't be surprised if silver is trading between $300 and $500 per ounce. With volatility, with scary pullbacks that shake your conviction. But the overall trajectory is clear. And gold would be far north of 5,000 at that point, potentially approaching or exceeding 8,000. Let me give you another framework for understanding silver's potential. When you adjust for money supply growth since 1980 and 2011, and you calculate where silver should be just to match the real purchasing power it had at those peaks, you arrive at numbers well into the couple $100 range. This isn't speculation. It's mathematical adjustment for currency debasement. Right now, most people aren't paying attention. Internet commentators are overwhelmingly calling for silver to crash. They're looking at arithmetic charts, seeing that silver doubled from 40 to 80 in a few months, and concluding it's overextended. They're applying normal bull market logic to an abnormal situation. This isn't normal. We're in a move to new reality, and those don't follow traditional technical rules. The pattern recognition shows that pullbacks are getting shorter. Used to be months of consolidation, then weeks. Now we're seeing multi-dollar drops that recover within hours. The spring is coiling tighter. Here's what you need to watch. The acceleration tells you everything. When markets that used to pause for months start pausing for days, when daily swings compress into hourly reversals, that's not a topping pattern. That's a market preparing to go parabolic. Oil is another factor that's going to impact the average person's perception of inflation. The technical work suggests oil is setting up for a violent move higher. Most fundamental analysts are calling for $40 oil. That's perfect. It means they'll be blindsided. The charts indicate oil could surge from current levels around $60 up into the mid-90s on the first thrust. A 50% spike. When gasoline prices jump like that, that's how ordinary people feel inflation. Not through money supply charts, through the pump, through grocery bills, through everything they buy daily. And that psychological shift is what ultimately drives the masses toward hard assets. The Sell America trade is already underway. US dollar, Treasury prices, stocks, they're all under pressure as global investors flee American assets. This has been building for decades, but it's accelerating now. You can blame politics, policies, administrations, whatever you want. But the underlying problem is the ongoing inflation of the monetary unit. We're not Weimar Germany, but we're doing the same thing in slow motion. Print, print, print. Prices rise. Assets inflate. Some things like gold outperform. Over the last 10 years, gold crushed the S&P 500, but it's all distortion. And you can't keep playing that game forever. Eventually, you have an accident, or more accurately, a consequence. Something breaks that's so large it creates intellectual doubt among academics, among policymakers, among voters who thought certain outcomes were guaranteed. Nothing works. When the stock market wipes out a year's worth of gains in a matter of weeks, which is only 15% but feels catastrophic to retirement accounts, people in the street start asking hard questions. What is this? Why doesn't anything make sense anymore? That's when uncertainty breeds emotion, and emotion drives herd behavior. And herd behavior in a monetary crisis means a stampede into real assets. Gold, silver, things that can't be printed or politicized away. Gold already knows this is coming. That's what's been driving it higher all along. It's not reacting to headlines, it's discounting a future monetary crisis. Most people in the Western world aren't awake to this reality yet. But they will be. And when they wake up, the rush into precious metals will be unlike anything we've seen. For now, the smart money is positioning quietly. Central banks continue accumulating. Insiders who understand monetary history are building positions. The crowd is still skeptical, still calling tops, still waiting for pullbacks that don't come or don't last. If you see a 10 to 15% drop in silver from current levels, that's not a signal to sell. It's a gift. Every major pullback over the last several months has been a buying opportunity. The people who bought the dips instead of selling them are massively ahead. Because somebody is buying. Not just individuals, but institutions. Here's a pattern worth noting. Before gold would hit a new high, like back in April, it would pause for 5 months. Sideways action. Doubters everywhere. But it never broke down. It just paused. Then it broke through and surged. In October, another pause. But this time only 2 months before the next leg up. Silver showed the same behavior. Year-long pause around $35 through late 2024 into early 2025. Boring. Frustrating. Then it broke through and jolted $10 higher. The process is layered, but the trend is unmistakable. Even on an intraday basis now, you can see the pattern compressing. Silver spikes to 95, spends the day getting sold back to 93. But instead of that taking 3 months or 2 weeks, it's happening in hours. Things are speeding up, exponentially. The bond market event could be the headline catalyst that shifts everything into high gear. If Treasury bonds break down decisively in the coming days or weeks, the Fed will face a choice. Let the bond market collapse, which destroys the entire financial system, or print currency on a scale that makes previous interventions look timid. They'll print. They have to. And that printing will send gold and silver into the stratosphere. By the second quarter of this year, based on the technical timelines and the historical precedents, we could be looking at precious metals prices that seem absurd today. But they won't be absurd in the context of a monetary crisis. They'll be rational. Bitcoin, for what it's worth, is likely heading much lower. The technical work suggests it could drop to 60,000, possibly lower, within the first half of this year. That would cut it more than in half from its recent peak of 127,000. A total wipeout for anyone who bought near the highs. And when that happens, the narrative that crypto is an alternative monetary unit will evaporate. People will stop talking about digital alternatives and start looking at what's worked for thousands of years. Physical, tangible, real. Gold and silver aren't speculative bets. They're monetary insurance. They're the exit from a system that's eating itself. Commodities broadly are entering another bull phase, similar to the 2020 to 2022 doubling in the Bloomberg Commodity Index. Oil is the laggard right now, which makes it the opportunity. Most analysts are bearish. They'll get run over when oil breaks out. The average person will feel this through gas prices, food costs, heating bills, and that's when the psychological shift happens. That's when people start questioning why their money buys less every single month despite being told inflation is under control. The answer is simple. The money itself is being destroyed, and the only protection is to own assets they can't inflate. Right now, you're living through a historic moment. It doesn't feel that way because it's gradual enough that most people don't notice. But the pieces are moving into place. Bond market stress, currency debasement, central bank panic buying of gold, retail skepticism, compressed consolidation patterns in precious metals, all the ingredients for an explosive move. The question isn't whether this happens. The technical patterns and historical precedents make it virtually certain. The question is whether you position yourself accordingly before the crowd realizes what's happening. Because once the masses figure it out, once the headlines scream crisis, once retirement accounts are bleeding and gas is spiking and bonds are in free fall, it'll be too late to get in at reasonable prices. The stampede will have already begun. This is your moment. This is the window. Don't wait for perfection. Don't try to time the exact bottom. Don't get shaken out by the volatility that's coming. Understand what's happening at the macro level and position yourself accordingly. If you found this valuable, do me a favor. Hit that like button and let me know you want more content like this here on Economy Breakdown. Drop a comment with your thoughts. Are you positioned for what's coming? What concerns you most about the current situation? Let's discuss. The financial system as we know it is being rewritten in real time. Your dollars, your savings, your retirement, they're all at risk in ways most people don't comprehend yet. But you're here, which means you're paying attention. Stay alert, stay informed, and most importantly, take action while you still can. This isn't fear-mongering. This is pattern recognition based on decades of market history, and the pattern is screaming one thing. Massive monetary upheaval is dead ahead. Be ready.